Good morning, everyone. Jude, I'm trying to get the... Oh, hang on a minute. Think about it. That's fine. Good. So, yeah, my name's David Hughes. I'm a partner at Harrelshaw Goddard, and my area of specialism is employment law. So, as you will appreciate, over the last couple of weeks or so, we've been very much involved in dealing with the furlough scheme, and most of the inquiries we're dealing with just now relate to that. The scheme has been launched with much fanfare, but little detail, at least to begin with. And we are getting more guidance through over the course of the last week or two. And indeed, there was further guidance over the weekend, which we've now been grappling with. So what I wanted to cover this morning in about 15 minutes or so is to go through the update on the guidance. I don't want to cover all of the scheme because that would take a bit too long, but I'll talk about the guidance that's been updated. And then there are some questions that have been asked by delegates and some other questions that we're encountering pretty commonly that I thought I'd try to run through as well. But this will be a bit of a whistle-stop tour through the update because we don't have a great deal of time to go into it in any detail. So the first thing, first question really was, does the scheme only apply to employees who would otherwise have been made redundant, or can you extend it to other employees who, for whatever reason, require to be furloughed? The guidance hasn't been particularly clear on that, but the understanding is that the scheme does cover more than employees who would otherwise be made redundant. But there's one exception to that, which I'll cover a little bit later on in relation to employees who are shielding and who are furloughed. The next point was, can non-UK companies claim under the scheme? And it's now been confirmed that they can. It's any entity with a UK payroll can apply. So that includes businesses, charities, recruitment agencies, public authorities, with some limitations. And it would include foreign businesses with UK local offices, provided they have a UK payroll and a UK bank account. There's confirmation being received that apprentices can be furloughed. You are allowed to continue training apprentices, and that is actually recommended. And there's further government guidance which came out just last night in relation to apprentices. I'm not going to go into that in any detail. It's quite long, quite detailed. But if anyone has particular issues relating to apprentices, either look out the government guidance or drop me an email either directly or through Jude, and I can send you a link to that. Public sector bodies generally aren't making use of the scheme and aren't expected to do so. And indeed, whether it's a public or a private body, if you're receiving government funding to pay your payroll, then it's expected that you won't utilise the furlough scheme. Government has confirmed that businesses in administration can furlough employees, but there's a caveat to that. And that is that it should only happen where there is a reasonable likelihood that the employees will be rehired later. So in other words, that's an administration where the administrator is looking at continuing the business and selling it as a going concern. If there's a liquidation type scenario, then you wouldn't be expected to furlough employees. It's been confirmed that employees on furlough cannot do any work at all. But if there is critical tasks that these employees ought to be carrying out, these can be allocated to other employees. I think that would have been the case anyway, and the guidance doesn't really add much to what we thought. Employees who are made redundant on or after, after 28th February can be furloughed. But the government guidance has clarified this a little bit, and what it now says is that employees who are made redundant or who stopped working for you after 28th February can be furloughed. So that seems to suggest that it's more than just employees who have been made redundant. Difficult to see where you would want to furlough employees who've been dismissed for misconduct or performance issues or something of that kind. But in any event, it does appear that that at least would be possible. Now, shielding employees, I mentioned that earlier, and you can claim for employees who are shielding in line with public health guidance. And again, there's lots of information about that online. But you can only do so if the employees are unable to work from home and you would otherwise have to make them redundant. And that's one of the few areas in the guidance where we actually see a reference to this link, this causative link between furloughing and the employees otherwise being redundant. Contrast that with employees with caring responsibilities, and it's been confirmed that employees who are unable to work because they have caring responsibilities resulting from coronavirus can be furloughed. The examples given are employees that need to look after children. They can be furloughed. But the guidance does not say this only implies if they're unable to work from home and you would otherwise have to make them redundant. So it looks as though redundancy isn't a relevant consideration when you're dealing with employees with caring responsibilities. Employees on fixed-term contracts, we knew that they could be furloughed, but it's been confirmed that during furlough, if their contracts are renewed or extended, then furlough can be continued. If their contract comes to an end, however, then clearly furlough has to come to an end as well. There's been an extension to the scheme, or at least further clarification in relation to the types of individuals who can be furloughed. And as well as employees, it's also been confirmed that you can furlough office holders, which includes company directors, salaried members of limited liability partnerships, agency workers, including those employed by umbrella companies, and what's called Limb B workers. As a technical term, it's this sort of hybrid category. They're not employees, they're not self-employed, they are workers, they have certain employment rights. They can now be furloughed as well. But the caveat is, in all of these cases, these individuals would have to be paid through PAYE, and the government grant would be based on the money being paid through PAYE. So, for example, directors who receive dividends otherwise than through PAYE could not have these dividends counted as part of their income for the purposes of working out the furlough amounts. In relation to office holders particularly, you understand that employees can't work if they're furloughed, neither can office holders, directors, etc. But if there are statutory functions that have to be performed by office holders, then they can still undertake these. Quite what these would be difficult to know. It might be things like, for example, completing annual returns to Companies House, something of that kind. It also is worth noting that individuals who are directors of their own personal service company can be furloughed as well. I'm not going to go into too much detail about the rest of that. If anyone's got questions in relation to the detail, we can cover that. An important point that's been raised in the guidance is that records have to be kept of employees who are furloughed. These must be written records and they must be retained for 5 years. So that's an important thing to remember. In terms of when the claims can be started from the date the employee finishes work and starts furlough, not when decisions are made or when they're written to confirming their furloughed status. So that is consistent with the idea that you can backdate furloughing arrangements. An important change that has been made to the scheme is that government has now confirmed you can claim for any regular payments you're obliged to pay your employees, including wages, past overtime, fees, and what they call compulsory commission payments, by which I assume they mean contractual commission payments. Previously, fees, bonus and commission were excluded from the scheme, but that would obviously have had a disproportionate impact on those who rely on commission for the bulk of their salary. So that can now be included in the calculation of the amounts payable. Discretionary bonuses, discretionary commission payments, non-cash payments, benefits in kind, etc., all required to be excluded from the calculation of what government will pay by way of a grant. These sorts of benefits do have to continue to be provided to employees, benefits in kind, if they are required under the contract of employment, because of course the contract continues, unless of course there's an agreement with the employee that these benefits in kind are suspended during the furlough period, and that would have to be an express agreement, I would suggest, in writing. There are particular provisions regarding salary sacrifice schemes and the employer's salary sacrifice schemes that reduce an employee's taxable pay should also not be included in the reference salary. You should note that salary sacrifice schemes can only be switched out of if there is a life event, and HMRC has agreed that the Covid-19 situation does constitute a life event, which could warrant changes to salary sacrifice arrangements. So that's something that can now be offered to employees. Apprenticeship levy and student loans continue as usual, and grants from the Job Retention Scheme do not cover these. Question that's been asked is whether, in relation to making claims, you have to continue paying employees or whether you can stop paying them until the grant funding comes through. The government's confirmed in the guidance that you should make your claim using the amounts in your payroll either shortly before or during running payroll, and claims can then be backdated to 1st March. Now that seems to me to suggest quite clearly that you have to pay the wages at the reduced level, the 80%, and then reclaim, rather than claim and then once payment is received, pay your employees' wages. So there could be a cash flow issue there for some businesses, and then you may need to look at bridging finance from your lenders, something of that sort. Confirmation again that the minimum furlough period is 3 weeks at a time, and that has to be a consecutive 3-week period, which I think was reasonably implied before. Once claims have been made, if you're eligible, then payment will be made direct to a UK bank account. The amount that is paid by government must then be paid in whole to the employees, and employers aren't entitled to deduct any fees or charges from that. It's been confirmed also that if the employee is furloughed, provided their contract of employment allows it, then they are permitted to work for another employer whilst they're on furlough. So it is entirely free for an employee to secure other, perhaps full-time work and receive furlough payments, and there would be nothing to prevent that provided the contract of employment allows it. If it doesn't and the employer were to consent to that, then again, I'm sure that would be fine. So some questions. We received some questions in advance. I've got a couple of these to go through first. Is it permissible to rotate furloughed employees? For example, have somebody off for 1 to 2 weeks, bring them back, put some others off for 1 to 2 weeks, and so on and so on. The answer to that is yes, but you couldn't do it on a 1 to 2 week cycle. You would have to do it on a minimum of a 3 week cycle. There has to be a 3 week consecutive period of furlough. The next question was, with the government's advice that the construction industry can continue with increased health and safety precautions, that's at odds with Scottish Government's advice that all but essential work should cease. Can we be certain that the government will honour its commitment to pay claims for furloughed Scottish construction workers and not dismiss these on the basis that their advice was that work could continue? Well, that's probably a question for government, but my take on it, for what it's worth, is that this is a UK scheme. It's administered by HMRC, and I can see no reason at all why employees who are furloughed in the Scottish construction industry wouldn't be covered under the scheme the same as any others. So yeah, the answer to that is yes, I'm sure that's correct. And a question specifically about seasonal employees. The questioner states, some stay on my payroll but don't have any hours between October and Easter, and others are taken on for the season. I understand those still on payroll will be eligible, but what about others? One of them has worked for us before and was due to return this season. Well, that is somebody who would not be eligible to be furloughed. They have to be on the payroll on or before 28th February 2020, and employees who have been dismissed or terminated prior to that clearly can't be covered. Also, one of my employees was on maternity leave last season. How do we work out how much pay they get on 2018 wages? The answer to that is you don't. In terms of working out the claim, you have to look at either the same month's earnings from the previous year or average monthly earnings for the 2019 to 2020 tax year. So if somebody didn't work last year for whatever reason and didn't receive pay, then there isn't any pay to work out the 80% on, so they aren't going to be covered by the scheme. A couple of other quick questions. I've only got a few minutes left. Can employees take or be required to take holidays during furlough leave? There's new ACAS guidance in relation to that. It will be easily found if you Google for it. And it does strongly suggest that furloughed employees can still request and take, or be required by the employer, subject to giving appropriate notice, to take holidays in the usual way. The ACAS guidance doesn't say what should be paid to employees during holiday pay. And this is something that isn't covered in the guidance either. My view is that as normal employment law continues, unless it's varied by the agreement of the employer and the employee, then yes, you do have to pay your employees holiday pay as normal. And do bear in mind that a contract, an agreement between the employer and the employee, can't contract out of statutory rights. As paid holiday is a statutory right, you would still have to pay the normal holiday pay no matter what you put in the furlough agreement. Does a period of holiday leave interrupt furlough leave? This is an interesting point when we're coming up to the Easter weekend. If you require to have a 3 week period of furlough and you suddenly have holidays dropped in the middle of that, does the furlough leave stop? You're not going to get your 3 week period. The guidance doesn't say. Every indication, I think, and logic suggests that a period of holiday wouldn't break the 3 week period for furlough leave, and that furlough leave would continue. There's no difference for an employee whether they're on holiday or whether they're on furlough leave. They're doing no work. The only change would be that they're probably entitled to be paid normal wages rather than the reduced furlough leave during that period. But of course, the government financing, the government grant would still continue. It's not clear from the guidance, but I think that's probably the right answer. There's an interesting point in relation to CHIPI, the Transfer of Undertakings Regulations, and if any of you have been involved in a CHIPI transfer since the 1st of March, you'll be wondering whether you can furlough employees who've transferred into your business. They weren't on your payroll as at the 28th of February 2020, so in terms of the guidance, you cannot furlough these employees. And that is the view that most employment lawyers are taking. Interestingly, Sean Jones QC, who's an eminent employment law barrister from down south, stated in a tweet that David Johnston MP has said that HMRC will allow employees transferred under CHIPI after the 1st of March to be covered by the scheme. But we'll have to get further guidance on that from HMRC. We prefer not to rely on tweets for our information. In relation to redundancy, we know that you can start redundancy processes during furlough, and the question has arisen whether employee representatives undertaking their duties as employee reps during redundancy consultation can remain on furlough. And the issue here is that employees on furlough can't undertake work for or on behalf of an organisation, and that includes providing services or generating revenue. Acting as an employee representative in a collective consultation for redundancies might be considered to be providing a service. So in that case, those employees might not be eligible then for government grant. It's an interesting point. It may also interrupt the 3-week period for furlough leave. So if you can, furlough these employees for 3 leaves before they start their duties as employee reps. And then bear in mind that financing from government in relation to those employees might not be permitted once they start their duties as employee reps. There are other things that you need to be aware of, even asking an employee to give a witness statement, for example, in relation to an employment tribunal that might be coming up. That could be deemed to be some form of work and could prevent that employee from being covered under the furlough arrangements. Another question that's cropped up is whether you serve notice of redundancy, which we know you can do, and you do that during a furlough period, what do you have to pay the employees during their notice period? And the reason that's being asked is that under sections 87 and 88 of the Employment Rights Act 1996, employers are required to pay normal wages during notice if the employee is willing and able to work during the notice period, but the employer has no work to offer. Now, provided the notice period that the employee is entitled to get isn't more than a week more than the statutory minimum, which is 1 week for every year of employment, then they are entitled to be paid their normal wages. The government would still pay furlough pay, so in those circumstances, employers would simply have to top up the wages to the normal amount. There were various other questions that I had, but I'm conscious that time is getting on, so I'll stop there and hand back. But there will be further questions later, so I'll be happy to answer those as they crop up.
Thanks, David. And next we will have Alana Sweeney from Shepherd and Wedderburn.
So by way of introduction, my name is Alana Sweeney. I'm a lawyer in the Restructuring and Business Advisory team at Shepherd and Wedderburn. So what I will look to cover this morning is just to highlight the proposed insolvency reforms in brief, to touch on a few of the other measures that have been introduced, and to comment on director responsibilities during this particular time. So I think it's safe to say that since the Covid-19 pandemic commenced, the UK and Scottish governments have sought to implement a number of measures with a view to providing support to businesses and their stakeholders where possible. And over the last few weeks, those measures have evolved and no doubt will continue to do so. There's also been recognition that businesses and directors and leaders of those businesses will be concerned about insolvency and the possible personal liability which could arise. So in order to provide some much needed breathing space to businesses to consider the impact of the current situation and to review the options available, certain insolvency reforms are to be introduced on an accelerated basis. And these are principally suspension of wrongful trading, the introduction of a moratorium, amendment of essential supply provisions, and introduction of a new process in the form of a restructuring plan. The amending draft legislation is currently still awaited, and therefore there's very little detail at present to explain exactly how these new reforms are going to operate. However, what we can do in the course of this morning is hopefully provide some context as to what's been outlined. So the first reform, which I've mentioned there, is suspension of wrongful trading provisions. So at present, it's intended that there will be a suspension of the provisions contained within the Insolvency Act for a 3-month period commencing the 1st of March 2020. And this is the only insolvency reform which has not been previously considered prior to the COVID-19 pandemic. So at present, an action for wrongful trading can be brought against a director by an administrator or liquidator, where they consider that prior to insolvency, the director allowed the company to continue to trade when the director knew or ought to have known there was no reasonable prospect that the company would avoid insolvency. And in reviewing any proposed action for wrongful trading, the court will look at the general knowledge, skill and experience of the director and whether the director took every step with a view to minimising the potential loss to creditors. And where there is a successful claim against that director, it could result in the director being made liable to make a contribution to the company's assets. So the proposed suspension of these provisions recognises that directors are facing exceptional circumstances and more significant challenges than ordinary trading conditions. And these circumstances will require them to consider and investigate the options available to them before they make an informed decision. So really here, what this reform is looking to do is to provide some comfort to directors that they will not be penalised where they have not taken immediate steps to cease trading or commence an insolvency process. But critically, it must be emphasised that this proposal does not amount to a waiver of a requirement to comply with the wider director duties. And I'll come on to discuss that point in further detail in a moment. The second reform that's being proposed is the proposed moratorium, and this has been suggested to add support to the proposed suspension of wrongful trading. So in this context, it's considered that a moratorium be introduced to provide a period of time during which a company will be protected from risk of enforcement action, whilst that company seeks to implement a rescue or restructure strategy. Again, there are no further details as to what this particular moratorium will entail. But what we can say is at the minute, there's a moratorium of 10 business days available to a company which intends to appoint administrators. And prior to COVID-19, it was proposed that a more widely available moratorium be introduced to enable a restructure or rescue strategy. But that previously proposed moratorium was only going to be available to companies which were solvent. So they couldn't have been in they can't be in an insolvent situation or been in an insolvency process in the prior 12 months. Rather, it required the company to continue to be able to meet its obligations as they fell due during the moratorium period, and it envisaged a monitor being appointed for the purposes of confirming that the company satisfies that eligibility criteria and continues to do so during the course of the moratorium. And that particular moratorium was also proposed as being for a period of 28 days, but it could be extended. So in light of the existing circumstances, it's unclear exactly whether the moratorium, which is now being proposed by UK and Scottish governments, will follow the same form as what they'd originally indicated. For example, it's not clear whether it will only be available to those companies suffering liquidity problems as a result of the COVID-19 crisis and who are seeking to implement some of the other measures that have been introduced by government, or if it will be more generally available. However, I think it is helpful just to remind ourselves that this is a possible mechanism that will be being introduced and which will hopefully provide some much needed breathing space for companies. The third reform which is proposed is in relation to the protection of supplies. So all we know at this stage is the UK government has indicated there will be some protection given to enable supply to continue and to avoid termination of contracts. The exact detail is again awaited. But again, it's worthwhile highlighting what the current position is and what current protections are available. So at present, insolvency legislation prohibits certain designated supply contracts from being terminated on grounds of insolvency, where the customer becomes insolvent unless the consent of the court or the insolvency practitioner is obtained. And the categories of essential supplies that are covered by those provisions are really quite limited. So they relate to principally gas, electricity, supply of communication, and certain electronic services. They don't provide or prevent for termination on other grounds in respect of those supply contracts. If, for example, there is an ability to serve notice to terminate, it's only in relation to grounds of insolvency that it seeks to prohibit. Again, prior to COVID-19, it was proposed that these existing essential supply provisions would be widened to catch any supply contract, not just the existing limited categories, and also to prevent termination, not just on the grounds of insolvency, but where a moratorium has been entered into or a restructuring plan is being implemented. So again, with the current circumstances, it's unclear exactly whether this previous proposal will be implemented or if it will be something different and be more specific to the COVID-19 situation. I think certainly with the way in which this measure was announced, there is a bit of confusion as to whether the current reform will now be aimed at preventing termination pre-insolvency, as I say, in the context of a moratorium or something of that nature. And if so, in what circumstances? For example, how will it catch that termination ground? Or whether it is intended that they will introduce something on a more extensive basis. I think undoubtedly businesses will require to consider the impact of these changes and how this might impact their supply chain relationships and their contractual rights as and when further details are announced. So it's one for us to keep a watch on. The last formal insolvency reform which is proposed is the introduction of a new process in the form of a restructuring plan. And this was also a feature of the pre-COVID-19 insolvency reforms, and it was touted as being the UK's answer to Chapter 11 bankruptcy in America. In reality, it's really a mix of the existing processes of schemes of arrangement and CVAs. And the purpose of this was to provide the ability for companies to compromise the of different classes of creditors, including secured and unsecured creditors, to enable a restructuring plan to be implemented, and on approval, intended that the plan would set out the right moving forward, with all previous rights being extinguished. As with some of the other reforms that I've mentioned, it was expected that there would be certain qualifying criteria for a restructuring plan to be available. However, solvency was not expected to be one of those requirements, and therefore it was anticipated it would be available to companies which were either facing insolvency or which were already in an insolvency process. So with the current circumstances and the proposal that this is now introduced on an accelerated basis, it remains to be seen whether it will take the same form as outlined previously, or whether it will be whether it will be a useful alternative restructuring tool in due course. So again, we could watch the space on that. Outside these formal insolvency reforms, it's also worthwhile flagging some of the other measures which have been introduced and which might assist businesses in gaining some further breathing space. So in addition to agreeing to defer VAT payments due for the quarter ending 30th of June 2020, HMRC have also indicated they do not intend on raising bankruptcy or winding up petitions for a period of time unless those petitions are essential, for example, due to fraudulent activity. HMRC have also announced that they are scaling up their time to pay arrangements, and I understand have now got a dedicated line available for those inquiries to be made. Aside from that, we have introduction of 100% rates relief, which has been introduced for certain businesses, principally in the retail, leisure and hospitality sectors, but with additional categories more recently being announced. And there's also some grants being made available by local authorities. And some of those grants are aimed at small businesses which pay little or no rates, and with others being available to businesses, again, in retail, leisure and hospitality sectors. And the availability of that in that sense will depend on the rateable value of the business. But it's worthwhile noting that just to be aware that there are some differences in terms of what those grants are and how they are available in the context of Scotland and England. So just be mindful of that in looking at the guidance. So having considered some of the reforms and the measures, I think it really does beg the question as to what does this all mean for directors and leaders in business. I'm sure you'll all agree that there's no industry or business which will not be impacted by the current circumstances, and there will not be a one-size-fits-all answer. Guidance is constantly being updated and gaps are constantly being identified, with further measures being implemented where possible to try and fill those gaps. And while some of the measures that I've mentioned already and the others available may provide some protection from insolvency and from personal liability, it remains vitally important that directors continue to comply with their duties to the fullest extent possible during this particular period of time. So in particular, the duties of a director under the Companies Act to act in the interests of its members, and importantly, to act in the interests of its creditors where there's financial distress, very much remain, as do the penalties for fraudulent trading and the sanctions of director disqualification, amongst others. So I thought I would close my part of the session with just some thoughts on some of the actions that we would expect prudent businesses and directors to bear in mind during these particularly challenging times. So first of all, I think continuous communication with stakeholders, including creditors and employees, to the extent possible. I think it's helpful to remember that it can't be assumed that others will know exactly what directors and leaders of the business are doing during this period of time. And it's important that those stakeholders can understand the proposed plans, particularly if their cooperation is required for trading to continue post-COVID-19. It's also important for boards to continue to meet and document what steps they're taking on a regular basis, and that includes accounting for progress that's being made and any changes that need to be accounted for as things continue. Undoubtedly, there'll be the need to continuously reassess financial models and the steps being taken to identify any viable financial rescue measures, including those announced by the UK and Scottish governments. And some of those measures may well give time to assess how the financial position may be improved and enable a revised business plan to be prepared and implemented. However, it cannot be forgotten that some of these measures will involve taking on more debt, which will ultimately require repayment. And it's worthwhile saying, as a reminder, that acquiring additional debt might not always be the appropriate thing to do, depending on the terms that are available and the wider financial position of the company. So it's important to also look at other steps that might be capable of being invoked, including seeking capital repayment holidays or renegotiating with other creditors or stakeholders where possible. On a more positive note, I think the current situation can provide some opportunities. So it's important that businesses do continue to look for the opportunities which might arise, including whether it's possible to operate the business in a different way, or if there are other changes in business practices that could and should be made going forward. We've already seen some of those opportunities arising in the form of technology firms capitalising on the situation, and certain manufacturing firms looking to diversify in terms of the products available, for example, what Brewdog and Ineos have been doing. And so there might be the possibility of previously unconnected businesses linking up to improve their current situation. Against that, it's also got to be cautioned against acting too quickly. So we have heard some stories of businesses just proceeding to cancel all direct debits to minimise financial exposure. I think that's something in particular that we would caution against. I think re-evaluating non-critical payments is undoubtedly wise, but taking an approach of just proceeding to cancel all debits could result in certain business critical payments being missed, for example, insurance, and which could potentially worsen the existing position. Consider carefully also offering vouchers and e-gifting. So again, we've seen a number of businesses looking to take up on this option, and it might very well be a credible approach, but businesses do need to assess their longer term future in proceeding with that option. So if there's no realistic prospect of a business being able to continue trading longer term, for example, if the business was suffering major financial stress prior to COVID-19, taking such steps could simply be seen as worsening the creditor position. And it may actually be in those circumstances that an insolvency process or one of the other restructuring options which I've mentioned today might be the more appropriate route. Checking existing insurance policies is also worthwhile being undertaken to the extent that that's not already been done. Whilst there have been many indications, and I'm sure in most circumstances the insurance policies will not cover pandemics, there may well be wider grounds for a claim, for example, due to government ordered closure. So it's important to review and seek advice on the terms of those insurance policies, and of course to maintain any business critical insurance as things continue. It's also important, I think, for businesses to be patient and realistic, and that might seem a bit of an odd thing to say when there is so much change ongoing. But I think what we can see is that the guidance is changing rapidly, and additional measures are being introduced to support businesses and employees. And that in turn is putting quite a lot of pressure on those responsible for implementing the measures. David's already touched on the extent of the changes in the guidance from an employment perspective, but I think that it's much more wider spread than that. So it may not be possible to obtain a decision on matters immediately. And in those circumstances where you are waiting on decisions to be made or information to be returned to you to enable your own decisions to be made, just ensure that you're continuing to monitor the position and be prudent in day-to-day operations and decisions. And finally, I think it sounds a bit trite to say this as an advisor myself, but it's important that businesses engage with their advisors, whether it's accounting, legal or otherwise. Advisors are there to help the businesses. The businesses can test their proposals, plans and options with their advisors and seek comfort from their experience and advice. And taking advice, even perhaps inviting legal or financial advisors to join board calls, will likely provide a layer of protection to directors managing this particular crisis. So I think in closing my particular part of this session, I think what's clear is there will be a continued period of uncertainty for many, and which will require us all to monitor developments. And we will of course look to share our updates and thoughts on them with you. I'm happy to take any questions for at the end of this session or beyond, but for the meantime, I'll pass over to Lynn, who will provide, I understand, an update and certainly make the financial measures that are being introduced.
Thanks, Alana. I've just moved rooms because my neighbour decided to start to cut the grass just as about to start there. So apologies for that. I thought there was enough background noise potentially. Right, I'm going to try and attempt to share my screen if that's possible. Okay. Okay, so I'm going to just give you a bit of an update on what's changed in terms of mainly the banking piece in the last couple of days, last week indeed. So last Wednesday, the Chancellor made some changes to CBILS, which is the Coronavirus Business Interruption Loan Scheme, as you'll all be aware by now. I'm not going to go through all of that in a lot of detail. I just wanted to put a couple of summary points down there first before we talk about what the changes are and give you a bit of bit of insight into what's been happening in the banking world in the last couple of weeks, and what you would need to do, I guess, to get yourself ready to approach your bank, and what they'll need from you. So you'll all be aware that that's a government-backed partial guarantee of 80% of the facility up to a maximum of 5 million. And the government has agreed to cover the first 12 months of interest payments and any lender fees. I guess that could be anything the lender would need, not just arrangement fees. It's important to remember that the borrower is liable for all capital repayments. So, you know, Alana's points are really relevant here. You know, from a cash perspective, you still have to be able to pay that if you're taking on new debt, and people should be mindful of that. Something that has been mentioned, but maybe hasn't been quite so clear in some of the narrative that we've had in the last couple of weeks, is that it's still the lender's money, it's still the bank's money. So the government only steps in if their loan goes wrong, and covers 80%. So the banks are the ones who are providing the funds, and have to go through their normal procedures. So in terms of the changes on the 6th, which I guess came into being yesterday, the loans now and the facilities now don't have to meet what was deemed to be normal commercial lending criteria. Well, they did. Prior, you had to go through the process of agreeing that it didn't meet normal commercial lending criteria first, whereas now that should speed things up by being able to go straight to CBILS without confirming that from a banking perspective. Personal guarantees. Previously, I think most banks had jumped on this anyway. If it was under 250k, they'd said they wouldn't look for personal guarantees, but that's now a requirement, that there aren't any, and indeed quite a few of the banks have said that they won't take guarantees at any level. And really, it's a case-by-case basis. It's worth chatting to your own bank to find out what their position is on that, and I guess it will depend on the individual businesses as well. One thing that has been sort of difficult to really get any clarity on, and it'd be interesting to know if we will in future updates, is the word viable. So the onus is on the borrower to confirm that the business would have been viable had it not been for the current crisis. So what does viable mean? So I guess in the way we would normally think of viable, can it survive, and will it still be in existence post this? Viable from a banking perspective, as in viable for bank lending, it could be completely different, and we don't have any real clarity on that. But I'll come back to more on bank policies shortly. I'm going to cover in the next slide some information on what we would expect you to have to provide to look at possible CBILS lending, and in a nutshell, you'll be asked for pretty much the same type of information you would have under a commercial lending proposal. So there's no real shortcut here, and actually there's probably more information required rather than less. The onus is on the borrower to demonstrate in the application that they have taken all reasonable steps as well. So CBILS is not something you can go to straight away without having shown that you've done everything else possible. And really that has to be done first, or to demonstrate that you will follow through on the things that you say you're going to do. So I guess if you are thinking that CBILS is maybe something that you want to look at, I would absolutely suggest that you look at all of those different options that are available, furloughing and all of the other measures that are available through local authorities, etc., which we've covered in previous webinars. The credit process is the same as commercial lending, so every bank has their own process and their own way of doing things, depending on what that may be, and the different layers that it has to go through in lending authority. This could take anything from sort of 2 weeks to 3 months. I mean, obviously, if you're looking for just a slight uplift in what you've already got, then that should be an easier ask. But if you're asking for a whole new facility and you've never borrowed money before, then from your bank, then the chances are that will take a fair bit more time, and there may be some legal process to go through that isn't just a case of uplifting an existing facility. The interest rate hasn't changed, or the guidance on that hasn't changed. Banks can still decide themselves what interest rate they want to charge, and all other lenders in the scheme. And again, the terms are at the discretion of the accredited lender. So I guess it's worth just thinking about that when you step into the process with your lender, to make sure that you're aware that those terms will be there beyond the period of the sort of 12 months that the government will be covering the interest payments. And obviously the usual advice would stand to get the right legal guidance on the documentation. There's a bit of debate around whether or not you can go to other lenders on the accredited list, and I think the view from from some is that that's not going to be possible. There are some banks who have said that they're only willing to offer CBILS to their existing customers. I guess some of the other tertiary lenders and maybe less of the high street banks may well be willing to look at taking this on and are used to taking on facilities with banks where they don't have the sort of main clearing facility. So it's worth considering, but I think the chances are that the best chance of success are probably with your incumbent bank in the first instance. In terms of the information pack, I've listed a couple of things here that you should think about, and most of these, if you've had bank funding before, will be familiar to you, but each lender will be different, and this is really just a guidance, but it's important that you speak to your own bank, your own lender, before you start to prepare all of this. So the usual things are there, up to 3 years financial accounts, historic numbers, up-to-date management accounts, age debtors, creditors, all of those types of things. Now, if there are PGs going to be requested by the bank, then they probably will look for information on the owner's assets, liabilities, income and expenditure, and possibly personal bank statements. But again, that's one to check with your own lender. Projections will be important. So typically a funder will look for 12 months, but probably 24 months of P&L, balance sheet, cash flow, integrated numbers. So that's a must. And some at the moment will also ask for weekly cash flow forecasts. So again, check with your lender. Valuations of assets, if you have them, will maybe be required, and that might be with or without the extra ask of additional security, but worth giving them that if you have those. A full business plan, that will always be required. The definition of full can change, so it can be a shorter one if you feel that's appropriate, but it has to have covered all of the key things that are important within what you would expect to see in a business plan. Demonstrating the viability prior to Covid-19 we've briefly mentioned, so it's important that you can demonstrate, and that'll be financially, but in other ways as well, that the business was viable prior to this happening, and more importantly, what's it going to look like, and what will your plan be to get back out of it and back on track quickly. And I mentioned that the measures that you've taken have to be mentioned, so a couple of them are here, but that's not a full list by any manner of means. So, overhead reduction, have you considered all of the different overheads that you should be reducing? Have you had conversations with your suppliers? Have you checked with your customers that they can still pay if you fulfil the next order? And have you got discussions ongoing with debtors as to when they will pay you to allow you to be accurate with the cash flow forecast? And again, that you've covered all of the government and Scottish Government measures. Last but not least, funding requirements. Obviously, a part of the cash flow projection will be to assess how much money you need and what proposal you have in terms of what the structuring of that funding would look like. Typically, quite a few of those things require advisor support. So there'll be plenty of people out there who can support to pull all that together, and we're doing that with our existing clients as well. So lots of support out there. You'll also have seen that there has been a scheme announced for larger businesses. So the big flaw in the view of the public and the business community was that businesses over £45 million of turnover couldn't access the business interruption loan scheme and had to use the commercial paper facility, CCFF, as I've got it written down there. So that's now come into being. It's fair to say, though, that very little detail is available on this. We know it's a £25 million maximum facility, and that the borrower will be liable for all of the interest and all of the capital. So differentiation there from the smaller scheme, in the sense that the borrower will have to pay the interest as well. There's no government contribution to that piece. Early guidance has been that the borrowers will have to exhaust commercial lending options first. So I guess it's possible that could take a bit longer. But given that we don't have a lot of information, I guess the guidance from us would be that you to start prepping now, so that information request list that was over the page will likely be required for the larger scheme as well as the smaller one. So while we wait for more information, it would make sense to start to prep now and to prepare for the viability test as well. Just very briefly, I wanted to cover off a couple of new measures. So the Scottish Government has issued some new measures specifically for certain industries. I'm not proposing to go through a lot of these because I suspect that very few in the call will feel these are relevant for them. But the links are on the slides, which you'll get at the end, so that you can have a look at those yourself. So there are a number of different creative sector funds, a bursary fund, or two bursary funds actually, and an open fund, which all offer different bursaries and grants. There's also an Innovate UK Technology and Innovation Grant competition that has been set up. That closing date's actually quite soon, 17th of April, I think. So if you are interested in that, then it's worth moving ahead with that as quickly as you can. And then there are also funds available for seafood processing and for fishing. If you could have a look at those. Lastly, and this has been highly welcomed because there's been lots of criticism as to the support that's available for charities and social enterprises and voluntary organisations. So this is a Scottish Resilience Fund which has been run by Social Investment Scotland amongst others, and there are grants of up to 100k available, as well as 0% interest loans starting at 50,000. So that information's there for anyone that needs it. So that was really just a whistle stop tour of some of what we're seeing and what we think will require to be prepared. And I will hand that back to Jude.
Hi, David Hughes has been busy answering all the Q&As as well, but he's got a few that he's going to answer on screen. David, do you want to take them forward now?
Yeah, certainly. Let me just scroll back till I find them. So the first one was, if an employee voluntarily left before the organisation decided to furlough and now wants to be rehired to be furloughed, are we obligated to be left to travel, not another role? I'm assuming this is an employee who left after the 28th of February, otherwise they wouldn't be eligible anyway. But the short answer is absolutely not. You're never obligated to furlough an employee. It's a decision that the business takes, and you're certainly not ever going to be obligated to take an employee back who has left. So, nice simple one to get started with. Through the JRS, we will furlough part of our workforce for 3 weeks initially. We then intend to rotate those employees and swap with the non-furloughed equivalents. The normal paid day is the last Friday of the month, so 24th April. We know we won't get government money through until May. Can I delay the payment to the furloughed workers until we get the money from the government? And the company would struggle with cash flow issues. Something that I think a lot of businesses are struggling with, and it's a question we've been asked by a number of businesses. There isn't a clear answer to it, but my interpretation of the guidance is that it's clearly envisaged by HMRC that payroll will continue as normal. There are a few clues, one I alluded to when I was doing the more general talk earlier. So my view is that you should deal with cash flow issues in a different way, either through some form of bridging finance from your lenders or government grants such as Lynn was speaking about, but continue the payroll as normal. If you didn't do that for any reason, and that wouldn't be what I recommend, then you would need a specific agreement from the employee to delay their pay, because otherwise doing so would be a material breach of contract, which could create all sorts of issues as well. I do know that lenders are looking at, for example, overdraft facilities to allow businesses to bridge these gaps, and I think that you'll probably get a fairly reasonable and fair hearing from your lenders if you need to get that type of finance. Next, if an employee, while furloughed, are paid holiday pay at normal rate, can the company still claim 80% of that holiday pay? My view is yes. There isn't clarity in the guidance about how holidays should be dealt with, but I think the general position that most employment law commentators are taking is that you pay holidays at normal rates as you normally would, but government grants will still cover that period. It's not 100% certain yet, but I'd be very surprised if that didn't turn out to be the position. And then finally, my employees work overtime, but this is not compulsory. Do you have to add this in when calculating furlough? Yes is the answer to that. When you're looking at employees who don't have regular salary and whose pay fluctuates, you can do one of two things. You can look at the corresponding month in the previous year and take that as your base, or you can look at an average over 12 months, and that would include overtime payments. The use of the word compulsory in the guidance is linked to commission payments. And quite what compulsory commission is supposed to mean, I'm not 100% sure, but I assume it means contractual commission. So yes is the answer to that as well. And those were the questions I was going to answer live. There are answers to other questions which are listed there, which you'll be able to see.
Okay, thank you very much. Anybody got any final things that they forgot to cover or anything like that before we introduce Paul back on the call? No, I think everything's okay. So over to Paul just to finish it up. And if anybody has any further questions, they can email us in at the info@sbrc email, and we'll distribute it to the speakers today or tomorrow. Thank you.
Thanks, Jude. Well, first of all, can I thank the speakers on the call today, David, Alana, Lynn. I'm sure everyone will agree there's a huge amount of detail there, and I, for one, will have to rerun the webinar to write everything down again. There's so much information. I think what's clear is that the guidance is still changing over time and still moving along. It's pretty clear that it's complicated as well, depending on what you're looking at, and therefore gaining professional input and advice from the best advisors is going to be essential at this time. It's not a straightforward thing. One size doesn't fit all. Pretty clear that management and stakeholders is going to be hugely important. But one of the best pieces of advice I ever heard in my business career was surround yourself with the best advisors and they'll look after you in times of trouble and complexity. And I think that stands more today than at any time before. I think, you know, the picture's still evolving. We're all hopeful that the lockdown will become a bit more relaxed in due course. Nobody yet knows when that will be. I think from a part equity standpoint, I'm the founder of Part Equity. We look after 40 companies just now. We're expecting it to be a bit of a long haul. And even when we come past the direct COVID impact, the ongoing economic impact in terms of the economy is going to continue on for some time. So even when we're thinking about resuming business post-COVID, we've got to be thinking we're entering a new kind of business regime, and it's still going to be pretty tough for some time to come. But without being too negative about it, there will be opportunities along the way. We are certainly, as SBRC and Part Equity, very hopeful that most, if not all, of the companies on this call will be able to get the guidance and advice they need and still be in business at the other side of the curve. And lastly, good luck, we're told, and I'd like to finally thank Jude for putting together a series of webinars, which I think have been essential guidance for anybody going through this process just now. Thanks, Jude.
And I'd like to thank Paul as well, because without him, I think I would have, I don't know, stopped doing them at this stage because of the amount of inquiries and stuff. But it's all really, really good, and we will keep doing them. We're going to take a break next week on some of them, maybe on the Tuesday, because we know people will want to spend time with their families and stuff. On Thursday, we feel that the time is right now to invite the banks and the financial institutions onto the next webinar. So Thursday we have the Royal Bank of Scotland, we've got Barclays, we've got Scottish Financial Enterprise, and we have Scottish Investment Bank as well. So that's at 10 o'clock, and there's an invite on Twitter and on LinkedIn as well for SBRC. So come along to that one as well. So they should be able to give out details around the CBILS and any other offers and stuff that the banks can offer. So that's basically from me. Any questions, we can follow up later on. So have a great rest of the week, everybody. Thank you.
Thanks.
Thanks.
Thank you.